Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for December 2024. Well, looking back at 2024, it's been another very good year for the tanker market, with rates well above long-term average levels. In fact, 2024 is set to be one of the best years for spot tanker rates, surpassed only by the last 2 years and a handful of years in the mid-2000s. Having said that, spot rates have come off in the second half of the year compared to the first half, and have been below expectations certainly during Q4, particularly when compared to the last two winters. And I think there's a couple of reasons for that. First of all, if we look at the last two winters, we saw a number of pretty significant geopolitical events which caused disruption to trade flows. So in the winter of 2022 and 2023, we had that was following Russia's invasion of Ukraine, and that was when the EU was banning the import of Russian oil. And so we saw this big shift in trade flows of Russian oil away from Europe towards India and China, which created a lot of volatility. And then last winter, we saw the beginning of attacks on shipping off Yemen in the Red Sea area there, which again caused a lot of diversion and disruption as ships started to avoid that region and go long haul around the Cape of Good Hope. And when you get these disruptions, it does cause a lot of volatility and spike in rates. Now those two factors are still in place and are still supporting ton miles, but they're not new factors anymore, and the market's a lot more settled and is able to trade around it. So we're not seeing that same level of volatility as we've seen in the past two winters. The other thing that's really impacted the market this year as well has been a very weak VLCC sector. So VLCC rates have continued to underperform Aframax and Suezmax rates, and that's been for a couple of reasons. One is that OPEC Plus continues to cut supply or continues to restrict supply in an effort to support oil prices. And we've also seen this year that Chinese oil demand and imports have been quite sluggish. Total imports in China are down from last year's levels. And furthermore, it's not just that China's importing less oil, it's that they've been taking an increasing proportion this year from sanctioned countries. So China's been getting about 30% of its oil this year from Iran, Venezuela and Russia, and a lot of that's moving on the dark fleet, so it's meant less demand for the regular fleet of ships. Having said that, rates are still well above average levels, and more significantly, they're well above our cash flow break-even levels. So we do continue to enjoy the benefit of a good spot tanker market. And certainly as we go further into the winter, we're seeing seasonal factors like weather delays starting to come into effect. And on the Aframax and Suezmax sectors, we are starting to see some volatility, especially in the Atlantic, which is helping to support rates here in the winter. Well, looking ahead to 2025, and what can we expect next year? Starting with the oil market fundamentals, we do expect oil demand to grow next year. If we look at the average of forecasts from the IEA, the EIA and OPEC, they are forecasting growth of 1.3 million barrels a day next year, which is slightly higher than the growth that we're expecting in 2024 of 1.1 million barrels per day. And the majority of that demand growth is expected to come from the Asia-Pacific region, particularly India, which is starting to overtake China as the main driver of oil demand growth. But we do expect a rebound in China as well next year. The government is in the process of implementing some stimulus packages to boost the economy, and we do expect that will help Chinese oil demand growth next year as well. Looking at oil supply, the forecast is for around 1.5 million barrels a day of supply growth next year, purely from the non-OPEC countries, being led by the United States, Brazil, Guyana, Norway and Canada. And most of that oil production growth is in the Atlantic basin. And as we just said, the demand growth is being driven by the Asia-Pacific region. So this growth in non-OPEC production next year should create ton-mile demand, because there will be a need to transport crude oil long haul from the Atlantic basin to the Pacific. Even if OPEC does not increase production at all next year, that growth in non-OPEC barrels and the fact that it's having to move long haul will create tanker demand. So if we look at this combination of growing oil demand and more oil supply to meet that demand growth, We do think that will create some ton-mile demand growth next year, and Clarksons is forecasting around about 2% demand growth in terms of crude tanker ton miles in 2025. Then looking at the fleet supply side, we're coming off a year here in 2024 where we've seen extremely low levels of tanker fleet growth, a very, very small order book this year. That does start to increase as we go into 2025, and all those orders placed over the last couple of years start to deliver. So we will see some more tonnage coming into the market next year. But it's quite a manageable level of deliveries. It's not abnormally high level of deliveries, and it's in line with what we've seen in prior cycles. And if we look at the tanker order book as a percentage of the existing fleet size, it's still hovering around that 13 to 14% mark, which is below the long-term average of 20%. So it's a manageable order book, but we will see more deliveries coming in the next 2 to 3 years here. But we also must bear in mind that the tanker fleet is aging. So the average age of the tanker fleet is now the oldest it's been since 2002. And while we're not seeing a lot of vessels being scrapped, we are seeing that as vessels get to sort of 18, 19, and certainly 20 years of age, what they have been doing is leaving the regular trading fleet and going into this so-called dark fleet or shadow fleet. That is getting a bit more saturated now. We've seen a slowdown in the second-hand sale and purchase activity for those older ships. But the fact that they've exited the sort of conventional or regular trading fleet has acted as an offset to vessels coming in. And so when we look at a combination of a relatively small order book, an aging tanker fleet, and the fact that shipyards now are fully booked really through to the end of 2027, we do think that tanker fleet growth will remain at fairly manageable levels over the next couple of years. So if we look at those together, as I said, we will get some tanker demand growth next year, some ton-mile growth of about 2%, and we'll probably get about the same level of tanker fleet growth. So that means a fairly balanced market next year, which should continue to support tanker rates. However, I think there are a lot of potential wildcards which could really influence the market next year, certainly in terms of geopolitical events. And we know from experience that those are often the things that will move the market the most. So there are a number of potential wildcards that could come in next year, particularly once President Trump takes power in January. So he's already signaled a few potential changes both on the domestic and international front. One is a potential ratcheting up of sanctions against Iran. So Iran has managed to increase its crude oil exports pretty steadily over the last couple of years, to the point now where it's exporting about 1.5 million barrels a day, most of which is going to China on the dark fleet. So there is an expectation now that sanctions on Iran may well tighten in the coming months, and that Iranian oil exports will fall, which if it does will mean that China will have to replace those Iranian barrels from elsewhere, whether that's other Middle Eastern producers or West Africa or US Gulf. And that oil will have to move on the regular fleet, the non-dark fleet. So that will be, if that comes through, that'll be a good boost to demand, especially in the VLCC sector. There's also the question of what happens with Russian sanctions. At the moment, we're seeing that, again, sanctions on Russian shipping and the dark fleet that's being used to transport Russian oil are getting tighter. We're seeing more and more ships getting put on the sanctions list by the US, by the UK, and by the EU. So again, that's restricting the ability of the dark fleet to transport that oil. But going even further into next year, I think we'll have to wait and see what happens with the conflict in Ukraine. I think President Trump has signaled that he is less likely to support Ukraine militarily and will try and broker a peace solution there. Whether that will happen or not, we don't know. We don't know if or when that would happen. But certainly any kind of change in that situation would have implications both for trade patterns and also for the dark fleet as well, and the relative balance of how much of that trade is carried on the dark fleet versus the conventional fleet. Trump has also mentioned potentially putting up tariffs into the United States. So he's talked about a 10% blanket tariff on all imports into the US, and also he's talked about 25% tariffs on Canadian and Mexican imports, and even higher tariffs on China. Again, we'll have to wait and see how all this plays out, but it could have an impact on seaborne oil trade. For example, if he does put the 25% tariff on Canadian oil, about 60% of US crude oil imports are from Canada. So if the price suddenly jumps by 25%, US refiners might turn to alternate sources, which would have to come by sea, and that could create extra tanker demand. And then finally as well, I think under a Trump presidency, we might see more support for the domestic oil and gas industry, which may, over the long run, lead to more US oil production and exports as well. So we again might be positive eventually for tanker demand. But all of those factors, I think, they're very difficult to predict, both if they will happen, when they will happen, and the net impact on the tanker market. But underneath all that, as I said earlier, the fundamentals do still support a strong tanker market in 2025. Though it remains to be seen if it's going to be at the same level we've seen over the last couple of years. So that's our update for this month, and we'll talk to you again in the new year.